With this video, we're going to utilize the FastCraft's Fundamental Analyzer software tool to analyze Cisco Systems, Inc., the worldwide leader in communication equipment as it applies to the internet. What's really interesting with Cisco Systems is when you look at it from the long-term perspective, it really provides insights into fundamental investing, but also investor psychology. From a business standpoint, going back to calendar year 1993, we can see that Cisco has really had some really strong earnings growth. They did have one really bad year back in the Great Recession of 2001, but then they followed that up with strong growth since then. Now, the orange line on this chart represents earnings per share growth. And as you can see, since 1993, the average operating earnings growth rate, that's non-GAAP, has averaged 24.5% a year. The black line is monthly closing stock prices, and here's where the investor psychology comes in. As you can see, in the beginning here, earnings and price tracked each other very closely, and then we ran into the infamous now irrational exuberant period where stocks in general, but tech stocks in particular, became ridiculously overpriced. And you can see here a quintessential picture of a bubble, how Cisco's stock price got completely disconnected from its earnings, and then of course the price collapsed, and of course the recession of 2001 impacted that. But then, since around 2002, Cisco's stock has traded more in line with its operating earnings. Now there's another line on this graph that really, I think, depicts investor psychology. FastCraft automatically calculates what we call the normal PE ratio for whatever time frame being measured. And here we've got 20 years of historical data plus 1 year of forecast. And the normal PE ratio, which is this blue line, is 38 times earnings. So to be clear, anytime the price touches that line or anywhere you touch that line, that would represent 38 times earnings. Now, it's mathematically correct to call this the normal PE ratio, but it's really an irrelevant number in this time frame, because the problem is you had this period here where that number, the normal PE was pretty valid. But then since the price got so crazy here, it was so much higher. Earnings PE ratios were in the 140 range, back in this time frame here, which was significantly above anything that's normal. And then since, calendar year 2004, the PE has been significantly below the 38. So even though this is a mathematically accurate number, it really has no meaning. But here's how you use that. You simply look at that to try to get a feeling for what PE ratio the market has applied. The orange line in this example represents a PE equals growth rate or PEG ratio calculation of 24.5. So in this iteration, this line represents 24.5 times earnings. This line represents 38 times earnings. And what we can take from this is there were periods here, during the 1999, even up all the way through 2002, where Cisco's PE was much higher than 38 times earnings. And then since 2003, we can see it was much lower. In fact, for this period of time here, it averaged around 15 times earnings. And then, of course, the stock price has traded at a much lower valuation ever since. So let's make an adjustment on the graph and see what happens when we look at a different time. With this iteration, we shortened the time frame for the last 14 years plus 1 year of forecast, or since calendar year 1999. We once again see the irrational exuberant period. We see how the price ultimately corrected, but because of overvaluation during this entire period, the orange line represents intrinsic value by our calculation, that the stock was massively overpriced. And I want you to notice that in this 15-year time frame, the earnings growth rate has only averaged 12.7% instead of the in excess of 25. So growth has been cut in half during this period, which I think partially explains why the PE ratio adjustment has happened. Now, let's take another look. Let's look at what's happened more recently. Let's drop this down to the last 10 plus years. With this time frame, we get another picture indeed again of Cisco Systems. We see earnings growth averaging now almost 20% a year, 19.1% a year. Now the PE on this chart, this orange line now represents a PE of 19. In the blue line, the normal PE ratio, which is a little more relevant than what we saw with the previous time frames, has now averaged 22. So since 2003, you can see that there was a time when Cisco's PE ratio was much higher. We have the opportunity to look at that using this graphic here. We can see by fiscal year end 2003, the PE ratio for Cisco was 38. By fiscal year end 2004, it had dropped to 28. Then by fiscal year 2005, it dropped to 21. And then by fiscal year 26 down to 20. And you can see this continuous drop in 2011 fiscal year, PE was just over 12, and currently the price earnings ratio is around 10.3 based on the closing price on November 13, 2012. But what I really want to point out here is you have a company who's actually had an acceleration of earnings growth over the last 11 years over what it had over the last 15. If you look at the bottom of the chart, you can see there is an element of cyclicality. They had an 89% growth rate in 03, a 43%, a 22, a 1%. You can see the flattening of earnings right here. And then, of course, growth, we had the 19% down year during the recession, but I do want to point out this was still a very profitable company during the recession. And then earnings, subsequently went up 24%, down 2% again, and then 18% last year, and expected under the current estimate of about $1.85. And by the way, I've seen this number as low as $1.70 to as high as $1.95. We're using the $1.85 number here, and after Cisco's last quarter, we think this number is a pretty good number. But what you see here is when the stock price was above the orange line, you clearly see that it corrects back to value, and then you see that when the price got below its value line, it ultimately comes back. And then, of course, here we are sitting now with a 10 multiple with a stock that we would argue is worth somewhere between $25 and $30 a share that can currently be bought at around $16.85. The stock is up strongly today based on a good earnings report that they just showed. But the real point of this article or this video is to illustrate that Cisco is currently not trading in line with its fundamentals. There has been a lot of negative sentiment on this stock over the last several years. In other words, we believe this stock is not trading in line with its fundamentals. We believe there's a lot of negativity, and a lot of tech stocks are facing that right now. But what also has happened in recent years is I want you to notice that Cisco in 2011 initiated their first dividend, and when you look at it from a performance standpoint, they have really grown that dividend very nicely since they initiated it in calendar year 2011. What the future holds for the dividend is still yet to be determined, but currently the stock offers a 3.3% dividend yield, probably a little lower than that because the stock's up 6% as I'm making this video. But a 3% plus dividend with the opportunity for growth appears to be very attractive. And then finally, let's take a final look at Cisco since calendar year 2010, kind of post-recession years. What we see is that the market did have a reasonably high price earnings ratio on this stock. At fiscal year end 2010, the stock was trading at a PE of 17. And of course, now that PE has fallen. Last year it was 12, and then this year it's already hovering around 10. And you can see that the stock price has dropped. There was a down year in earnings in 2011. These are operating non-GAAP earnings. But then the company has grown, nicely since, and they reported a really nice quarter, currently. And so they've averaged about 15% growth, 14.7 over the last 4 years. The consensus of leading analysts, and there are 23 analysts reporting to Standard & Poor's Capital IQ, expect this company to grow earnings at around 9.5%. I like to think of that as somewhere between 8 and 12%. I noticed Zacks analysts are reporting about 8.9%. But the point is, if this company does give us this kind of earnings growth, then we would argue that it ought to command a PE ratio closer to 15 times earnings, which at a 9.5% growth rate would indicate a fiscal year end 2013 fair value of 27. Last year's fair value would have been about 23. And then, of course, we expect that fair value to be increasing steadily, assuming the company gets these kinds of earnings increases. But we believe the opportunity for a strong dividend increase, as well as following the strong earnings growth that we expect, or the above average earnings growth, is certainly a reasonable and plausible estimation. So we would argue that this stock is currently very cheap. A lot of it has to do with investor sentiment kind of being negative and not putting what we would consider to be a fair multiple on this company based on its actual operating results. And therefore we think there is relatively low downside risk, or relatively little downside risk from here, although the market can do strange things. But on the other hand, we think there is an opportunity for several ways to make money in this stock. We think PE expansion is something that can occur over the next couple of years. We do consider, we do believe we're going to get continued earnings growth, and we think the dividend will be increased as well. So someone looking for a high quality addition to their retirement portfolio might, want to take a closer look at Cisco. It's a terrific company. It's dominant. It has the size and scale to compete, and we believe the internet is going to continue to grow in the future, and Cisco is going to be a major participant and player, and in that growth. Consequently, we would rate Cisco a buy.